Hello students, welcome back to the another session of Accountancy. In the previous class we are discussing about the first financial statements of not-for-profit organization, that is receipts and payment account. The theoretical part and practical aspects we are discussed in the previous classes, and today we are going to discussing the second financial statements of not-for-profit organization, that is income and expenditure account. So let's go to the next financial statement, that is income and expenditure account. Now what is income and expenditure account? What is income and expenditure account? The income and expenditure account is equivalent to the profit and loss account of business enterprises. It is prepared by matching revenues against the expenses for a specific period, usually a year. However, since this is not a profit-making institution, it is known as income and expenditure, and the balance is not known as profit or loss, but it is known as deficit or surplus. Here, the matching revenues against the expenses means one side of the account we record expenses and on the other side we will record the revenues, that is income and expenditure. However, since this is not a profit oriented institution, the account is not known as profit or loss account. The account will be known as income and expenditure account. We have just replaced the word profit and loss with the word income and expenditure, and the balance of this account will also replace the profit of the year. The balance is known as profit or loss account. The balance will be known as deficit or surplus. In the profit and loss account, the balance is known as whether it is profit or losses. But in the case of income and expenditure, the balancing figure is known as surplus or deficit. Now, deficit is the expense more than income, or surplus is income is more than expenses. Have you clear? So, this is income and expenditure account. Now we are moving on the features of income and expenditure account. The following are the important features of income and expenditure account. The first one, it is revenue account prepared at the end of the financial period. It is a revenue account, that means it is a nominal account and it is prepared at the end of the financial period. So, this point number 2, this account is prepared by matching expenses against revenue of the period concerned. What is more important is the expense and the revenue should belong to a particular period. It is prepared once in a year. We are going to match 1 year of expenses with 1 year of revenues, and it should be the same period. So the point number 3, all expenses are shown on the left hand side, that is debit side, and point number 4, all incomes are shown on the right hand side, that is credit side. It means it's a revenue account, so debit all expenses and losses and credit all incomes and gains. So the next feature is both cash and non-cash items are considered. For example, depreciation, like that. In income and expenditure account, we will consider both the cash and non-cash items. Now for example, on the expense side, we might find salary, we might find rent, we may also find something that is known as depreciation. Salary is a cash expense, rent is also a cash expense, but depreciation is a non-cash expense. So it considers both the cash and non-cash items. Then the point number 6, all capital expenditure and capital incomes are excluded from income and expenditure account. If you remember in the previous video, the preparation of receipts and payment account, it said it records both capital as well as revenue items. However, income and expenditure exclude the capital items and not recorded capital expenditure and it not recorded capital incomes. Like items like purchase of furniture, it included in receipts and payment account, but it will be excluded from income and expenditure account. It is not a revenue expense and it will not appear in income and expenditure account. So the point number 7, only current year incomes and expenses are considered. It's only current year incomes and expenses are considered. It considers current year incomes and current year expenses. Now here is very important whether the amount that is received belongs to the current year, because if the amount is received for the previous year or the next year, then it should not be included in income and expenditure account. Again, what is the important? If the expenses or incomes are incurred, even if the expenses are incurred for 12 months, those paid for 10 months, it will be considered as an expense for 12 months and include in income and expenditure for 12 months, even if they are paid for 10 months. The next point, if incomes are more than, the balance is known as surplus, and if expenses are more than, the balance will be known as deficit. If the incomes are more than the expenditure, then the balance will be known as surplus, whereas if the expenses are more than the income, then the balance will be known as deficit. In the receipts and payment account, you start with the opening balance of cash and bank and ends with the closing balance of cash and bank, and the account is tally. But in the income and expenditure account need to be balanced. It's like a profit and loss account, and find out the profit. In that case, that will be known as surplus, and loss here in not-for-profit organizations account will be known as the deficit. Have you clear? The last point said that if incomes are more than the balance is known as surplus, and if expenses are more than the balance will be known as deficit. That means in the case of income and expenditure need to be balanced. It's like a profit and loss account. Find out the profit. In that case, that will be known as surplus, and loss in the profit and loss account, that will be known as the deficit. And we have to summarize the income and expenditure account. The first one, it is prepared for a period, and next one, it is a revenue in nature. Third one, debit to the expenses and credit to the incomes. The next one, only revenue items are recorded. Next one, only expenses for particular period are considered income and expenses both. And it considers both the cash as well as non-cash items. So this is the main features of income and expenditure account. So we are moving on the next aspect, that is the specimen or format of receipt, income and expenditure account. So this is the specimen of income and expenditure account. Let me give you a specimen of income and expenditure account, so it will helps to clearly understand what I am talking of income and expenditure account. First one, write the name of the institution. That is, here we have to write the name of the institution in the top line of the income and expenditure account. And we have two sides. Here, the income and expenditure account has two sides. One is debit side and next one is credit side. So, first one is debit side and the second one is credit side. Only expenses we have two sides, one is debit side and the credit side. Only expenses in the debit side, like to salaries, to outstanding salary, to rent, to insurance prepaid, printing and stationery, repairs of equipment and depreciation of furniture, equipment, books, sundry expenses, and the last one is surplus, that is the balancing figure. And income side by subscription, outstanding subscription, subscription received in advance, donation, entrance fees, sale of all the newspapers, sundry receipts, rent received, and the deficit, that is the balancing figure. So let's put everything into practice. First one, an income and expenditure account is a revenue account. Debit all expenses and it credit all incomes. So the income and expenditure, in the debit side of income and expenditure is expense and credit side is income. So the debit side shows all expenses and credit side shows whole incomes. So debit starts with expenses and credit starts with incomes. It records all expenses, that means cash as well as non-cash items. You can see printing and stationery and repairs of equipment, depreciation, etc. The depreciation is a revenue expenses, but it is a non-cash items. Depreciation is a revenue expenses, but it is treated as a non-cash items. One more point is to be noted. It records all the expenses for a particular period. Now you look into the specimen salary. Here the salary is the add outstanding irrespective of salary paid to the entire period, add the outstanding and put it for the period, and the other example insurance and less prepaid. So the outstanding salary and prepaid insurance are also shown in the income and expenditure account. We would subtract, in the case of insurance, we have to be less insurance, less prepaid, and we would subtract as the prepaid, that is insurance only for the particular period. That means it records expenses only for the particular period. Do you understand? And finally, when we closing income and expenditure account, we can get the balance. The balance is either deficit or surplus. Surplus means, the term surplus means it is the balance. Actually, this the surplus is the balancing figure. Surplus means the total of income side is greater than the expenditure side. Then the balance will be known as surplus. And what is deficit? The term deficit means, what is deficit? The term deficit means if expenses are more than incomes, then the balance will be known as deficit. So this is the simple specimen of income and expenditure account. So the detailed version will have to be discussed at the time of practical session. So next we are moving on the difference between income and expenditure account and receipts and payment account. Both financial statements are prepared in the not-for-profit organization. So what's the difference between receipt and payment account and income and expenditure account? So we are moving on the difference between receipt and payment account and income and expenditure account. The first one, the receipts and payment account is a real account. What do you mean by real account? What is the real account? The point number one is receipts and payment account is a real account. What is the rule of real account? Debit what comes in and credit what goes out. But in the case of income and expenditure account is a nominal account. The receipts and payment account is a real account and income and expenditure account is a nominal account. What is the rule of nominal account? Debit all expenses and losses and credit all incomes and gains. So this is the rule of income and expenditure account. Then the second part, the receipts and payment account is a summary of actual cash receipts and payments of particular period. And in the case of income and expenditure account, it is the summary of incomes and expenses of a particular period. So in the receipts and payment account is the summary of actual cash receipts and cash payments. So it records all cash items. And in the case of income and expenditure is the summary of income and expenses only. Then third point, it includes both the capital and revenue items. In the case of receipts and payment account records both capital and revenue items. But in the case of income and expenditure, it incomes only revenue items. It records only revenue items. Then fourth point, in the case of receipts and payment account, it includes all receipts and payments irrespective of the period to which it belongs to. That is, the current year amount, previous year amount and the future period amounts are recorded in receipts and payment account. But in the case of income and expenditure account, it includes only incomes and expenses of a particular period for which the account is prepared. In which year the account is prepared, the incomes and expenses are recorded or included in that particular period only. Then the fifth point, in the case of receipts and payment account, it does not include non-cash transactions. The receipts and payment account does not record non-cash transactions. But in the case of income and expenditure account, it includes both the cash and non-cash transactions. The last point of receipts and payment account, it begins with the opening balance of cash and bank and ends with the closing balance of cash and bank. The receipts and payment account is starting with the opening balance of cash and bank and end with the closing balance of cash and bank. But in the case of income and expenditure account, it does not have any opening balance of cash in hand and cash at bank and closing balance of cash in hand and cash at bank. The closing balance or balancing figure of income and expenditure account may be either deficit or surplus. So the balancing figure or closing balance of income and expenditure represent the deficit or the surplus. So this is the main difference between income and expenditure account and receipts and payment account. So both the accounts, the income and expenditure account and receipts and payment accounts are the important financial statements of not-for-profit organization. So both the statements have its importance. So the next class onwards, we are moving on the practical sessions of income and expenditure account. How to prepare income and expenditure account and what are items are included in income and expenditure account, that can be detailedly discussed in the next class. So thank you for watching this video.